Tesla has just seen a 45% rise in just 12 trading days following Donald Trump's presidential victory. This move has caused Tesla to break out from a downtrend that had been in place since late 2021. Elon supported Trump during the presidential campaign, and so far, it seems that his bet has played out nicely. But can Trump's presidency really change the course of Tesla's future? Does this change anything about the factors that have been driving Tesla lower? To answer that, we have to first look at Tesla's fundamentals. Like most stocks, the primary driving force behind Tesla's price is its ability to grow its revenue. This is the chart of Tesla's revenue over time. As you can see, over the long run, the company has seen its revenue grow massively, with the release of multiple successful electric vehicle models and becoming a breakthrough company in the EV space, contributing to the stock's spectacular performance. But as you can also see, Tesla's revenues have been leveling off since about mid-2022, and one of the reasons for this is simply that they've been selling fewer cars. This chart is a good example of how Tesla has been selling less cars. It shows us the number of cars Tesla sells per quarter, and we see that in 2021 and the beginning of 2022, Tesla saw quite a rapid growth in the number of cars they were selling. Since then, however, we've seen them struggle to maintain that growth. In fact, they've seen a pretty steep contraction in the number of cars they sold in the first quarter of 2024. In this same time period, Tesla has also started to face some pretty fierce competition from its Chinese rival, BYD. The company has caught up to the number of cars that Tesla sells. BYD produces cars that are significantly lower priced than Tesla's, with their two main models being more than 2 times cheaper than the 2 cheapest Tesla models. Likely a result of this increased competition, Tesla decided to cut their prices by as much as 20% in January 2023. While that decision certainly makes their cars more affordable, it also means that Tesla is reducing their profit margin. And that's what this chart shows us. Tesla has gone from having an impressive 17% profit margin to now just around 9%. As you can see, that's a similar dynamic to what we witnessed between 2014 and 2018, the period of time where Tesla's stock was pretty much flat. Back then, the company was eventually able to reverse the tendency and increase its profitability in 2019. For now, that hasn't happened yet. And what happens when you see both revenues leveling off and profit margins declining? That leads to lower earnings, or company profits. Indeed, when we look at Tesla's earnings over time, although they had a spectacular move up between 2018 and 2022, since then, we've seen Tesla's earnings steadily decline. They've gone from $5.50 per share to around $3 per share, a 30% decline. The fundamentals of Tesla were not that great heading into the election. Now, as you can also see from this chart, there's been a very slight tick up in the estimates of Tesla earnings since the election. But it's difficult to say whether this is a direct result of the US election. It's definitely possible that analysts are expecting that Trump will provide more favorable conditions for Tesla during his mandate, and so that's already starting to push up their expectations of Tesla earnings. Many believe that Trump's policies, such as reducing electric vehicle subsidies and imposing higher tariffs on Chinese imports, would disadvantage Tesla's competitors more than Tesla itself. Tesla still holds around 17% of worldwide market share for battery electric vehicles. This established market position could allow it to thrive, and reduced subsidies would hurt competitors more than anything else. Moreover, tariffs could hinder the entry of cheaper Chinese electric vehicles into the US market, which could provide a further boost to Tesla's sales. Now, all of this is still very speculative, but if it does drive Tesla earnings higher, that could allow the stock to finally perform well and potentially hold this breakout that occurred following Trump's win. Because, believe it or not, Tesla's valuation is at the same level it was in 2019. This chart shows us exactly that. This is the price to earnings ratio of Tesla. So basically, how much investors are paying for each dollar that Tesla earns. And you can see in mid-2019, the PE ratio of Tesla was at around 100, which is around the same level where it is today. Eventually, PE ratios reached 220 by mid-2020, so more than double from a year earlier. This rise in PE ratios resulted from a surge in earnings that the company witnessed during this period. If excitement on the stock comes back and persists, it wouldn't be crazy to see valuations get back to these high levels. But that's if the excitement comes back. What if it doesn't? A PE ratio of 100 is actually very expensive for a company that isn't growing. If earnings fail to get Wall Street excited about the stock again, Tesla's valuation could potentially head in the very opposite direction and deflate back down to 40 to 60, where they were for most of 2022 and 2023. That could lead to as much as a 50% decline in the stock's price. So from a valuation standpoint, Tesla is really in the middle of its usual range. This gives a lot of risk if it isn't able to boost its earnings, but a lot of reward if it does. Two key catalysts that could boost Tesla's earnings are robo-taxis and Tesla robots, which Elon Musk introduced in a recent Tesla conference. Now, while these ambitious projects could lead Tesla to completely revolutionize the tech industry once again, just like it did with electric cars in the first place, these projects, unfortunately, won't be generating any revenue for Tesla in the short term, and ultimately, that is what Wall Street cares about. The only thing that can support Tesla's run-up today is a pickup in its vehicle sales. And that would depend on the degree of advantage that Tesla is able to generate following Trump's tariffs, and whether demand for electric cars starts rising again. The goal of these videos is to show you exactly what you're trading when it comes to certain stocks and assets. And ultimately, while the company has many promising projects long-term, the only way Tesla continues rising from here in the near term is by seeing a pickup in the number of cars that they're selling. And not seeing that could damage the stock's performance further.